Okay, so again, annuities liquidate an estate, but a life insurance creates an estate.
Okay.
How does it create an estate? Well, yeah, because right now I'm covered for like, let's say $1 million, and when I die, I literally am creating $1 million estate for my wife, ¿verdad? So, but then what is she gonna do with it? She's gonna put it into an annuity, and she's gonna liquidate the $1 million to herself in form of monthly payments. That's what an annuity is for. So I'm just repeating. I know you're already getting it, or you got it already, pero I just want to repeat it over and over, but that way you could separate what a life insurance is and an annuity is, because they're both on the test. There's 8 questions on the test on annuity, so you gotta definitely know that. So that's an annuity. An annuitant is a person that's actually getting the benefits, receiving the benefits, receiving the income. Okay. Owner, the person who purchases the annuity, owner of the annuity is the person that bought the annuity for the annuitant. And the owner could be also the annuitant. So I could buy an annuity for myself. I'm the owner and I'm the annuitant. But not necessarily. Beneficiary. Beneficiary is a person who receives the benefits should the annuitant die. ¿Verdad? So the beneficiary receives the benefits if the annuitant dies. You know, so if I'm the annuitant, I die, the beneficiary is my wife.
Yes.
All right, annuity characteristics. We talked about this, but it's good review. There's 2 periods, the accumulation period and the annuity period. So the accumulation period is a period that is going up.
Yeah.
You're accumulating money by saving it, and then it's growing also. There's getting interest. It's invested either in a fixed annuity, a variable annuity, an index annuity, and I'm making payments on top of that, so it's growing. And then there's the annuity period, which is the period of time that it goes down. And for this, it's called the annuity period, okay? And you get your money by way of settlement options. By way of settlement options.
And that's all the settlements we just went over.
Yeah, which is a few of them. So the test wants to know that you know how all settlement options work, like the mechanics of it. Porque cada uno tiene every one of them has its purpose, you know. Has its purpose and the way it works and its reason and stuff like that. Oops, let me delete this stuff. All right. So immediate annuity, that means you get the money right away within 12 months, ahí está. Or deferred annuity, you get the money more than 12 months, so the money grows tax deferred. So if you're going to get the money later on, while it's sitting there during the accumulation phase, it's going to grow tax deferred growth. Tax deferred growth. So that's a good benefit. I mean, that's the reason why people want to get annuities, because of the tax deferred growth. Whether it's qualified money or not, that's pretty damn good.
Yep.
It's a good benefit. Does that make sense? Any questions on that?
No. Benefit payments begin. It's hard to write on this thing.
All right, let's keep going. Oh, beautiful. Look at that. That's a beautiful chart that shows the settlement options, how it works. That's pretty cool. This one shows a good visual. I'm gonna use that too. I'm gonna screenshot it. See, I'm gonna go back. Let me go back. This is a cool one. Screenshot. Screenshot. Delete this one. Save this one. And I'm gonna save it and post it up on my chart here. Give me 1 second, okay, because this is good. Dang, this is good collection right here. All right, let's keep going. So ahí está, mira, the pay-in period is the accumulation period. And while it's growing on a fixed annuity, on a variable annuity, or index annuity. The other one, what was it? The deferred something? You have notes right there? On the fourth one? I forget the fourth one. It's called something deferred.
Oh gosh, you think I'm gonna be able to read this writing? Deferred annuity?
No. Yeah.
There was the accumulation period, and then there was the annuitization. Was it annuitization? I'm making up words now.
No, that's a word.
When the money starts coming out? Is that what you're referring to?
No, that's it's growing. So look at where you have notes about a fixed annuity, variable annuity, index annuity, and then there's a fourth one.
Fixed amount.
Nope, that's settlement options. Keep going.
Go back more.
Yeah.
Fixed rate of refund, fixed annuity.
There you go, right there. Keep going.
Variable interested.
Yep, variable. Keep going.
Back or?
Yeah, keep going forward.
Variable index.
Index, yes, after index.
Deferred annuity.
Nope.
Get payment. Straight life. Immediate annuity.
No, you're in a different topic now. It was after index. That's okay. You wrote it twice. Let's see.
Additional annuity topics. Annuity insurance product.
Oops, my bad.
Annuitization, pulling money out. Single premium, rollover into annuity. Flexible premiums, monthly basis. Also money.
That's okay. We'll go over it again, because it's I don't see it on the test a lot. I see more fixed annuity, variable annuity, index annuity. I don't see that other one that we're trying to find out, but we'll find it.
It's gonna pop up right now. Watch.
Probably, yeah. Okay, so annuitization period is settlement options. Oops, settlement options. So how do you want your money? So it's going to talk about it right now. Date of annuitization is usually when you retire. When you retire, okay? That's pretty simple, right? I mean, can you remember that?
That was easy.
Pretty simple, right? So annuities, how long are the benefits? How long are benefits paid? That it depends on. Oh, beautiful! Look at this, man. They did a good job with whoever did this is awesome. This is a good one too. I'm gonna screenshot this because this is another way to explain annuities. I'm getting all these good ways to explain annuities. This is good. This one's for the color, the people that learn by colors. Okay. So let me go back, sorry. So annuities, that's for the first one. How can I get my payments? Single or flexible? How can I contribute into the annuity? Single or flexible? How many lives can be covered? Single life or joint life? Right? Or survivor? So that's like, how do you want your money? This is one of the settlement options. You want single life, so like that's the straight life. Remember the straight life? Or multiple people could get income, and that's joint life or joint and survivor. Okay. Remember that? Joint life, first to die, joint and survivor, last to die. Next one. Who can receive benefits? No, when?
Can I receive my benefits?
So the when is immediate and deferred annuity. I could receive my benefits within 12 months or after 12 months. And how long are benefits paid? Well, this is more settlement options. Fixed period or fixed amount, right? Or cash out, ¿verdad? Or life annuity. So it's pure life, life with period certain, pure life or straight life, life with period certain, refund life, or joint and survivor. And how can I invest my premiums? This is the one I was telling you. So there's fixed, there's variable. Oh, it's not even here. It's not even here either. Yeah, it's missing. Index is missing here. Index is missing here. So there's two more. There's fixed and variable, and then there's index, and then there's that fourth one that we're still looking for, okay?
I think you mentioned those four the last time
on the previous
Yeah.
one. All right, it's already going into question. We'll find it. It's towards the end. So let's find it right here. Watch. Check it out. We're going to find it right here. Because I went over it just now. Yep, it's going to be right here. This is the one right here. Look at this.
Index annuities. Equity
So it's index annuities or market value adjusted annuities. Market value adjusted annuities. See that?
Let me just take a picture of that.
Yeah, it's two of them.
Those are the two that we're missing.
So this is during the accumulation phase. It's going to grow two different ways.
Yes.
Index, which is going to go in the S&P 500, not go into it. It mirrors the S&P 500. So it's tied to an index. So it doesn't give you the whole return because it doesn't give you dividends. It doesn't give you stuff like that. It's tied to it, and there's a cap, and there's a cap in the bottom and cap in the top. So it just mirrors it. The market value adjusted annuity, let's read it completely, right? So it's a single premium, first of all. So you're going to give a lump sum, but you don't get it right away. You get it later on because it's a deferred annuity.
Okay.
A deferred annuity means after 12 months, right? With a guaranteed interest rate for a specific maturity period, usually 3 to 10 years, with a surrender charge that depends on the current market interest rate at the time of surrender. So basically, it's like it's an annuity that you get later on, but it gives you a guaranteed interest rate in the beginning, usually 3 to 5 years. So it gives you like a guaranteed, and then after that, well, whatever the market does. But I don't see it a lot. Okay. So if you forget about it, I think you don't need it to pass, but you do need to know fixed annuity, variable annuity, index annuity, and all the stuff that we're going over. Like that's why I didn't remember that, because it's not that important. You could miss some and still pass, you know. So I'm giving you the big chunks, the big stuff. Okay. Let's go over the cool little charts, man, because that's really cool the way this PowerPoint describes it. You're gonna have to memorize the terms on chapter 1, okay? Like hazard, you know, representations, warranties, all this stuff, aleatory, unilateral, conditional. These are just vocabulary words you just have to memorize, you know.
Unilateral, can you explain the aleatory and the unilateral one more time?
Okay, unilateral first. Oops, that went too far. Unilateral, just think one. Uni is in the root, right? Different root words. So uni in Spanish means único. That means only one, right? Only one, único. So just think of uni, one party, legally bound to do anything. And that's the only one that sounds anything like that.
Yeah.
There's another one that's called take it or leave it basis. Adhesion. Adhesion is also, it's kind of like one. Adhesion means one party prepares it. So see that? It's prepared by one party. And the other party either takes it or rejects it. The other party says, hey, so that one party that prepares it says to the other party, do you want it or not? Take it or leave it. That's called adhesion. That's the contract of adhesion.
When would you use that?
Is the insurance company that makes an offer to the client.
Okay.
So it's when does the insurance company use it? Whenever they wanna like be picky.
Okay.
You know, they tell you, hey, you want it or not. So they are the ones that are offering you, and you as a client, you have no choice. You want it or not?
Take it or leave it.
No, I want to negotiate. Nope, you can't negotiate. You want it or not? This is what I have to offer. Take it or leave it. You see that? So it's kind of like a firm offer, you know? Not a best offer, it's a firm offer.
Solid. Okay.
So that's adhesion.
And then there is the aleatory.
So it's like in real estate. When the seller says, I'm only selling it for $1 million, I'm not going any lower than that. So that means you're offering a contract of adhesion.
Okay.
That's the same thing in insurance.
Okay. And then aleatory?
Aleatory, an exchange of unequal value. So aleatory is just a concept, okay? It's like life insurance is a perfect concept of aleatory. So life insurance, like let's say I have $1 million in coverage, I'm only paying, let's say, $150 a month. That's aleatory because for $150 I get my wife gets $1 million. Dang, that's an unequal value. You see that? And if I die this month, my wife gets $1 million and I only paid $150. Damn, that's a great deal. That's aleatory. That's the concept.
She doesn't have to put up with you and she gets all that money.
I know, dang. I know, she gets to live the good life. She's going to be sad and rich. Better than sad and poor,
Sad
right?
and poor, huh? And then there's the conditional. Conditional. Certain conditions must be met for the contract to be executed. The insured must pay the premiums and provide proof of loss for the death benefit to be paid.
Yeah, so this is just like a conditional contract. Like certain things have to be met before the contract is executed. That's just use common sense on that one.
Conditions need to be met.
Yeah.
And who creates those conditions?
The insurance company.
Okay.
It's always the insurance company. Underwriting. Underwriting. You know what underwriting is?
I do know that.
Yeah. Insurable interest. What is insurable interest? You remember that?
No?
Let's go over this. Why not?
do it.
It's vocabulary words. Let's just go from the top. Okay, so insurer
The company that sells the insurance.
is the company. Insured
The person that buys the insurance
is the client. Policy owner,
is the one. That's the one that buys it.
that's the client that buys it.
I
Yeah.
buy the policy.
So the insured is the actual client. The policy owner is a client that buys a policy, not the client that's covered. So both of these are clients.
They're
See
both
that?
clients. So I could be a policy owner and I could buy insurance for my dad. He would be the insured, right?
Yes.
Okay.
From the insurer. Applicant is the person completing the application. It's usually the insured or it's usually the policy owner también.
And then the beneficiary is which would probably be if I'm writing out if I'm buying a policy, if I'm the policy owner buying the policy on my dad, I want to be the beneficiary.
Yep. Oh yeah, so there's a good point. So the policy owner could be also the beneficiary and the applicant. But he can't be the insured because if I'm buying a policy on me, then somebody else is going to be the beneficiary. Okay, you get it. So it's
Can I get this right?
yeah.
Hello.
Certificate of authority, admitted insurers, non-admitted insurers, mutual insurers, and insurers owned and controlled by its policy owners. Mutual insurers issue participating policies which pays dividends back to the policy owners.
No. Let me call my dad to tell him to go open the gate out there for you.
Return of excess premiums.
Okay, as soon as you go in, make a quick left, and it's the second mobile on the right. It's number 144. So, yeah, as soon as you go in the gate, make a quick left, and it's the second one on the right. There might be a red Tundra or a gold Honda out there. Sure?
Okay, right here. Let's go. Oh, you. Okay.